Good morning, everybody. Nothing like a few technical issues before we start the session. Thank you for joining us this morning on this not so beautiful day. Do hope the sunshine shines for us this afternoon. For those of you that don't know me, my name is Lisa Kennery. I'm one of the directors here at Pierce's. I actually head up the payroll department. Before we start this morning, just a little background regarding payroll. The legislation this year is probably a little different to ordinary. Normally we do receive quite a lot of legislation to go through. This year has been very little. Having said that, the payroll department has had a very hectic 12 months dealing with furlough. I hope you'll have joined us a few minutes early and would have seen the slides on a loop, which showed how we supported clients through furlough and obviously in the next 6 months coming. If we don't already process your payroll and you have got any questions within that topic or any topic, do feel like get in touch with us. We're always available on the end of the phone or via email, and we'll provide our contact details in the chat box afterwards. We're very lucky this morning in that we're joined by Philip Johnson. Philip is our assistant payroll manager within the department. He looks after the day-to-day runnings and any technical questions that you may have are pointed in this direction. We'll go through various topics this morning for you, which I will let Phil go through. Any questions that you have throughout the session, feel free to pop them on the chat box. Now, the chat box is set up as private, but we will still see those questions coming through and we'll cover them off at the end. We've also got a feedback survey that will follow at the end of the session. We'll send that on an email separately and that will come out by our administrator, Lauren Myers, so just watch out for that email. Without further ado, I shall pass you over to Philip. I hope you enjoyed the session and any feedback, we're most grateful. Thank you.
Well, thanks, Lisa, for that. Yeah, as Lisa said, there's not an awful lot that's changed this year, but what we're going to do, because we were going to have an event last year to cover off the changes from April 2020, but because that never happened due to the pandemic, we're going to cover off some of the things that came into force last year and just run through them just to make sure that they haven't been missed, and just to, and if you already know it, it's just to enforce your knowledge there. So. Okay, so what we're going to look through today is we're going to have a look at the new rates and thresholds for the upcoming tax year. We're going to have a look at the statutory sick pay for coronavirus, statutory parental bereavement leave and pay, employment allowance, holiday pay, class 1 Class 1A NIC on termination payments, employers' national insurance and holiday for veterans, and off-payroll working. And then at the end, we'll just cover off the CJRS scheme, which has been extended. Again, like I say, you'll probably recognise a lot of them from things that came into force last year and things that you've probably been doing for the past 12 months. But again, we'll just cover them off. And if you have any questions on any of the topics, please just put them in the box and we'll cover them off at the end. Okay, so the tax bandings for this year, there's not a massive change. They've gone from 1250L to 1257L for the personal allowance, and you can see that the basic rate and the high rate tax bandings have increased ever so slightly as well. So the Chancellor's confirmed that these income tax bandings are going to remain the same for the next 4 tax years. So for 2021 and then 4 after that. That's in order to try and combat the huge cost that the pandemic's cost over the past 12 months. These are the English and Northern Irish rates. There are different tax bandings for Scotland. They have a starter rate at 19%, which is on the first £2,097 that they earn. I've not put them on here because they're sort of few and far between. I don't think many people have them, but if you do have any Scottish employees that live or work in Scotland, you'll see that they have a tax code with S at the beginning. The same applies for Wales. Their tax bandings are actually the same as the UK and Northern Ireland, apart from you'll see that they have a C at the beginning of their tax code. The national insurance thresholds, again, there's not much change here. So the lower earnings level has remained the same. That is the point at which the employees start to gain credits for national insurance. So start to earn a credit for the pension and where they become eligible for SSP, SMP and SPP. The primary threshold has gone up slightly, and this is the point at which the employees start to pay national insurance. So any earnings above this will be paid at 12%. The secondary threshold is the level at which the employer starts to pay national insurance, and again that's gone up ever so slightly. And then any earnings above the UEL, the employee then pays national insurance at 2%. That has also been capped in line with the tax thresholds, and that's going to be capped for the next 4 years or so. National minimum wage. So the Conservative government have tried to get the national minimum wage up in line with the Low Pay Commission's advice. So they've kept that in line this year, but it remains to be seen whether they'll be able to do that ongoing due to the cost of the pandemic. So you'll notice this year there are a few extra categories. So there's they've scrapped the 25 and over, which was previously at 872, and they've introduced the 23 and over, which is now at 891. The 21 to 24 has also been canned, and they've introduced a 21 to 22 at 836. So if you've got an employee who was say 23 and on 820, they're going to have quite a large pay increase to 891 this time around. They are also looking for next year to try and bring the apprenticeship rate in line with the 18 to 20, sorry, the under 18s rate. But again, that remains to be seen as to whether they think that the country can afford that. Statutory payment rates, again, it's a similar story, not much to report here. The maternity, adoption and paternity rates were all at 151.20 per week. These have had a slight increase this time to 151.97. The statutory sick pay rate has also gone up ever so slightly from 95, it was 95.85 to 96.35. Okay, so first topic that we'll look at is statutory sick pay. So we'll look at what it is, who's eligible, and how you go about reclaiming. So when this slide was actually first made sort of last year, we were a bit unsure as to what it actually meant and how people would go about paying it and reclaiming it back. But we know a bit more details on now, and I imagine everybody at some point has probably had to pay COVID SSP and reclaim it back. So what is it? It's sick pay for anybody who has to self-isolate or has been notified that they've got coronavirus. It's payable from the first day. So if an employee is off sick, rather than having the 3 waiting days, they'll get sick pay from that first day. Employers with under 250 employees as at February last year will be able to reclaim the first 2 weeks SSP back. That's per employee. So if an employee does go off sick, was off sick last year and has gone off sick again this year due to COVID, you can only reclaim one of those 2 week blocks back from the government. And to reclaim that back, what you need to do is you need to go onto your online portal, page one for employers, and you need to you can reclaim it from there. So you have to pay it out via your payroll and then request a reclaim separately. If we do your payroll, or you have an agent that does your payroll for you, they can do the reclaims as well via their own agent portal. One thing I would just note on here is for anybody who is going on to statutory sick pay for COVID, they do still have to meet the qualifying rules for normal SSP, and so there does still have to be a 4-day period of incapacity for work before they then get that sick. So now we've got fast testing where you get results back in 30 minutes or sort of within a couple of days. If they are only off for 1 or 2 days, unfortunately, they wouldn't then qualify for SSP, and so that's just something to be wary of. The next subject is not a very nice topic, and one that I hope that nobody ever has to look at, but we will run through it just to bring everybody up to speed. So this is statutory parental bereavement leave and pay. So again, we'll look at what it is, who's eligible for it, and what to process and how. Okay, so any employee, regardless of how long they've worked at the company, will be entitled to 2 weeks leave if they lose a child under the age of 18, or if they suffer a stillbirth after 24 weeks of pregnancy. It doesn't have to be taken all in one go, so it can be taken in 2 one-week blocks if need be, but the leave must be taken within 56 weeks of the date of the child's death. And the entitlement will apply to the death of each child. So who's eligible for the parental bereavement leave? So a child's parents, the adoptive parents, biological parents of the adopted child, but that's only if the contact is still being kept after the adoption. A child's parent in fact, so a parent in fact is someone who doesn't fall into the above categories, but has been living with the child in a parental capacity for at least 4 weeks prior to the death. And then the partner of any of the above, where they've all lived in an enduring family relationship. And all that means is the partner of any of them who it's not a platonic relationship or it's not siblings living together. So if it's somebody in a relationship like a civil partnership or a marriage, and they've been sort of co-parenting. So who is eligible for statutory parental bereavement pay? So obviously that's different to the leave. So everybody's entitled to the leave, but the pay is slightly different. So the pay is paid at the usual rate of 15197, or 90% of the employee's average weekly earnings. But for an employee to be eligible for the pay, they need to have been employed for at least 26 weeks at the relevant week. And the relevant week is the week before, so it would be 26 weeks before the week before the death. Average weekly earnings for the employee must be at least £120 per week, and that's for the 21-22 tax year. So again, same as last time. The pay should be reported on the FPS with all other earnings, but to reclaim it back, it's done in the same manner as SPP and SMP, and that's submitted on an EPS. If you're a small employer, so your NIC is under £45,000 for the previous year, and then you'll be able to reclaim 103%. For anyone who's not a small employer, then you'll still be able to reclaim some of it back, but it'll just be at 92%. Employment allowance. So again, this is something that I think everyone probably is aware of, and has claimed at one point or another. So we'll go through the history of the employment allowance, what's changing, and what you need to do going forward. So The employment allowance was first introduced in 2014, and it was to offset the employer's Class 1 NIC bill by £2,000. That actually coincided with when they scrapped the reclaim of SSP. So at one point you would be able to reclaim your SSP for your employees. In 2016, that got uplifted to £3,000. And under the original sort of schemes, they said that you only had to submit your EPS once to notify the revenue that you were claiming it, and that would then stay for the duration of the company. So last year in April, the rules did change slightly, and I know that the revenue have had to release quite a lot of documentation and publish quite a few notes on this, because I think some people had been submitting this wrong and been claiming it wrong. So employers with Class 1 national insurance bill of over £100,000 or more in the previous tax year are now no longer eligible. Employment allowance now does also fall under de minimis state aid rules. I've spoken to loads and loads of people on de minimis state aid rules, and I'm yet to find anybody that has claimed that prior to April 2020. But that's something we need to be aware of. So under de minimis state aid rules, depending on what sector your industry is in, you'll have different thresholds. So I think the usual one that applies to most people will be €200,000. So it's still quite a lot. So, and that's split over a 3-year rolling period. So if you do know that you claim state aid and it might take you above your threshold, you do need to consider employment allowance for this as well now. But if you're not sure on that, give us a call and we can have a look at that with you. The employer declaration should be via EPS should be submitted each year ongoing. So rather than just submitting the one return, that'll now need to be done at the beginning of the tax year. The reason for that is then they can you have to do a constant assessment. So you need to keep reviewing whether you're going over that 100,000 and if you're claiming any state aid. Also from April 2020, they increased the allowance from 3,000 to 4,000. One thing I will mention again on the state aid is furlough doesn't class as state aid, but COVID SSP does. So again, if you have been claiming quite a lot of COVID SSP, that's just something that you need to be aware of. So what do you need to do? So again, you just need to determine whether your Class 1 employer's NIC exceeds 100,000 across all companies in the group. So when it says £100,000 for Class 1 employer's NIC, you do need to look at every company that falls within that group. So it might be that on the individually that they don't go over that threshold, but across the group they do. So again, just keep a lookout for that. And then you need to calculate the total de minimis state aid claimed. It might be as well that you are no longer eligible, and so there are some exemptions to employment allowance that can sometimes be missed. So perhaps the status of the company's changed, and so you are no longer eligible. So things like if you're a director-only company, or you have a director-only company, you shouldn't be claiming it through that. If you employ somebody for personal household, so nanny or a gardener, you can't claim employment allowance under those circumstances. Or if you're a public body, or you do at least 50% of your work for a public body, such as the NHS or local council, then you then can't claim it either. Holiday pay. Holiday pay is quite a fun topic, and we don't really have a lot of time to go into it in full detail. So again, we're just gonna brush over it. But if I say anything on here and you've got any concerns about how you've been calculating holiday pay in the past, or if you want to start looking at bringing in these changes now, again, get in touch and we can have a look at that in more detail. So we'll look at the previous rules, what you should have been doing. We'll have a look at what's changed and what you need to do. This again came in April 2020. So again, a lot of you probably will have been doing it for the past 12 months, but if you haven't, it's just something that you'll need to look back and revisit. So the previous rules, so statutory minimum holiday entitlement for most employees is 5.6 weeks, and that's including the bank holidays. And so that's for somebody who's working set days per week. So for example, for somebody who works 5 days per week full time, they're entitled to 5.6 weeks minimum, which is the equivalent of 28 days. For employees on shift work or no fixed hours, then you should do an average of well, you used to have to do an average over the 12 weeks worked, and that is the 12 worked weeks. So if you had any weeks where an employee didn't work, you'd then have to go back and look even further to find a complete week. If employees get paid any overtime, commission, or any other regular payments, these should also be included as part of the calculation. The reason being, employees shouldn't be losing out just because they're going on holiday. So if an employee usually works 40 hours, gets 5 hours overtime, and there's commission payments as well, if they were then just to go on holiday and get paid 40 hours, they'd be losing out on what they would normally be getting paid, and so it might deter people from taking leave. So what's changed? So in April 17, the Independent Taylor Review of Modern Working Practices recommended that the holiday period be extended from 12 weeks to 52 weeks. And so the same principle applies. So rather than looking at 12 weeks worked, you now need to look at 52 weeks worked. That was accepted by the government, and it was brought into effect from last April. So the reason for the change is it gives a clearer picture for the employees. So it might be that they are seasonal workers, or they're busier in certain times in the year, and so you get a better average of what their usual pay is. It also stops employers from stopping employees having time off during just after busy periods, where they know that they're going to have to pay out quite a large sum of holiday. So it makes it fairer for the employees. So what should you do? So you should use the 52-week period instead of the 12-week period. If you can't find a full 52 weeks in that period for worked weeks, you'll need to go back up to 104 weeks to try and get 52 weeks worked. I'm yet to find a HR or payroll system that allows you to do this properly, and so there might be extra steps that you'll have to put in place alongside any system or any process that you've currently got, to try and make this as accurate as possible. Again, talk to us if you're not sure, and we can have a conversation and try and find a resolution. Yeah, if you do have fewer than 52 weeks pay information, just use what you've got. So if you've only got 40 weeks, use 40 weeks as the average, and obviously the more weeks they work, the more data you'll have. So termination payments. So there was a change again last year on termination payments. So we'll look at what the rules were, have a look at what's changed and what you need to report. So currently, payments under 30,000 for redundancy or termination payments are free of tax and Class 1 NIC, but any payments above that are subject to pay-as-you-earn tax. From April 2020, termination payments, they now incur 13.8% Class 1A NIC charge. This is employer charge only, and so there's no cost to the employee. The NI charge is actually reported via your payroll, so via RTI, and so it needs to be paid along with your pay-as-you-earn. One thing you need to check on that is just to make sure that your system, your payroll software, does have the functionality to report on Class 1A national insurance. Class 1A NIC is usually associated with benefit in kinds, and it's usually submitted on your P11DB. So the fact that they're now bringing this into payroll and into RTI, it does suggest if anybody does payroll benefits, it could be the first step and sign that they are going to start to look to bring Class 1A payments into payroll rather than them having to be submitted on a P11DB. So employers NIC holiday for veterans. So this is something that's been talked about in the media quite a lot, and you've probably heard about this. So the premise on this is that to try and encourage employers to take on people who have left the armed forces, they're giving them an employer's NIC holiday for the first 12 months that they're employed. So we'll look at who qualifies, how you reclaim it, and the record keeping. So this is something that's new to this year. It was mentioned last year, but at that point they didn't have the functionality in place to do the reclaims, and you won't be surprised to hear that they still don't, but they're going ahead with it anyway. So anybody who's served in the armed forces for a day, even if that's just for basic training only, will qualify for this. and they'll be eligible. You'll be eligible for the holiday for the first 12 months of their employment, and that's the first 12 months of their first employment after leaving the armed forces. Like I say, there currently isn't a system in place to reclaim this money back, so you'll have to continue to pay your employer's NIC as normal for these employees, and then from April 2022 they're going to release more details on how to request it back. I'd imagine it's going to be a similar process to how you request your COVID SSP. From next tax year, they are planning on introducing a system so you can reclaim it back in real time. Whether that's going to look similar to your sort of maternity and paternity reclaims, or if that's going to be an extra NI category. I'd probably go with the latter of the NI category, because you've already got your H's and M's for apprentices and under 21s. So for record keeping, so if you do have any employees that qualify for this holiday, you'll need to keep records for at least 3 years, and you need to get proof that they have been serving as in the armed forces. So that could be a P45 from their employment in the armed forces, it could be their contract, it could be a dismissal letter, it could be their ID card as well. So if you've got a copy of that, keep it on file, because what you'll have to do is when you come to make your reclaims, you'll have to show that you have made the efforts to get that information. Again, we're not sure exactly what that will look like, but it's better. You can't have too much information when it comes to the ID. So just request what you can. So off payroll working. So again, this is something that everybody will probably be aware of, or have heard about. Contrary to a lot of people's beliefs, it isn't anything new. It has actually been in since April 2000, but there has been some rule changes on this. I'm only going to go over it relatively briefly, and because we have got a session, I think you've probably seen on the initial slides, we've got a session on the 19th of March, and where we're going to go into a lot more detail on this. So I'm going to give you a quick overview of what IR35 is, and then we'll go into the payroll implications of that. So like I say, IR35 was first introduced in April 2000, and the rule on that is, so it meant that any individuals who were paid through a personal service company but would otherwise have been treated as employees are taxed in the same way that employees are. So that rule has been in place since April 2000. The problem was that the revenue were unable to tackle that, because there were thousands of personal service companies, and they obviously didn't have the manpower or the resources to go out and try and to combat that. So the rules that have changed, so in April 17, sorry, what they did is they changed the rules slightly. So then, rather than the onus being on the personal service company to decide whether they had to pay these taxes, it was then put onto the contractor. That meant it reduced the pool of companies that they then needed to tackle to find out whether these personal service companies were paying the right amount of tax. And they first implemented that for public sector companies only, and that was in April 2017. So the changes that are coming into effect from this year, again, this got pushed back from last year due to COVID. The changes that are coming into effect now are that for medium and large companies in the private sector, this will now apply. So the same rules that apply for the public sector companies, this will now apply for the private sector. And so it's up to the private sector contractors to determine whether the personal service companies that they are paying and taking on should fall under IR35. So if to qualify as a medium and large company, then, sorry, to be classed as small company for IR35, your annual turnover needs to be less than 10.2 mil, balance sheet total less than 5.1 mil, and have under 50 employees. So you need 2 of the 3 criteria to class as small. So if you are a small company, that doesn't mean that you're exempt from the IR35 rules. The rules are still in place and they still do apply, but the onus is then on the personal service companies to determine whether they should be classed as off payroll working. So the payroll implications for this. So most payroll systems now, because the rules have been in place for public sector workers since 2017, a lot of payroll systems will now have a function where you set up a new employee, it'll have a button for off payroll working. So again, check with your software provider to make sure that that's in place. So you should set up any workers with that button ticked. Tax and employees' national insurance should be deducted from the pay, as you would a normal employee. And employers' class 1 NIC is also calculated, so you'll be paying that at 13.8%. There's no requirement currently to deduct student loan or any court orders, and you don't have to assess them for auto enrolment, so you don't have to put them into the pension scheme. One thing on the employer's class 1 NIC, if you are claiming your employment allowance, unfortunately you can't use that to offset against your off-payroll workers. So that can only go against your employees. So again, check with your system, but if you process the payroll yourself, have a look at whether you can split your payroll into your true payroll employees and your off-payroll workers. That way you then should be able to split your employment allowance, so it's only being claimed against those that you're eligible to claim it for. Although it doesn't, the class 1 employers NIC doesn't, you can't really claim it against the employment allowance. Any earnings that you pay to your off-payroll workers will count towards the apprenticeship levy. So if you do have, if you are currently paying apprenticeship levy, or you're on the border and you've got quite a lot of off-payroll workers that you're going to be putting on from April, that might well tip you over, and so it might be that you need to then start paying the apprenticeship levy. At the end of each tax year, you should provide them the off-payroll workers with P60, and that needs to be given by the 31st of May at the end of the tax year, and P45 should be provided if the off-payroll workers leave. There isn't any obligation to provide off-payroll workers with pay slips, but we would recommend doing so. It just keeps things transparent, and you've then got a log and a statement for that worker for each month or period that they're paid. Okay, so coronavirus job retention scheme. This has probably been the everyone's sort of the front of the minds for the past 12 months, which is why I've covered off some of the other changes again, because I think everyone's efforts and everyone's focus has probably been surrounding this. So furlough has been confirmed to be extended until the 30th of September, which I think took us all a bit by surprise. I think everyone in the sort of payroll world was expecting it to be extended, but only to sort of July time. So the fact it's been extended to September is brilliant news, as it gives that support now for another 6-month period. Everything's remaining the same from now until June, so the employers are able to reclaim 80% of the regular earnings, but the only change from now till June is that from the 1st of May, any employees that were on the payroll from the 2nd of March will now be able to be put on furlough. So there was probably quite a few employees that missed the last furlough scheme, and so they'll now be eligible to go onto the new scheme. From the 1st of July, the employees will still get 80% of the hours not worked, but employers will have to contribute 10% of that. And then for August and September, it's now going to be capped at 60%, with the employers having to pay the additional 20%. So again, the employee is still receiving the full 80%. Like Lisa said at the beginning, there wasn't an awful lot on there. That's why we've gone through things quite quickly, because we wanted a lot of the things on there probably people were already aware of, but it was just to have a recap, and just to raise any points that people might have missed over the past 12 months. So if there is anything on there that you think that we've gone through quite quick and that you want a bit more details on, get in touch with me or Lisa, and we can have a separate conversation about that. Again, like I said, the sort of new content that was available for this year was quite sparse. So I believe we've been getting some questions in the.
We do have a couple of questions that are regarding furlough, so if I read them out, Phil.
Okay.
So what is the minimum furlough period?
So when furlough was first introduced, you had to be on furlough for a minimum of 3 weeks, and if that 3-week period was cut short, that employee wasn't eligible. You weren't eligible to reclaim that money back from HMRC. That's been scrapped. So I think it was when flexi furlough first came in, that got scrapped, and so there's now no limit to the minimum period. So if somebody wants to go on furlough for a week, then you can do if they've not been on furlough previously.
Okay, thank you. And can I claim under the CJRS for notice pay and accrued annual leave?
So if an employee's leaving and they're in their notice period, you used to be able to claim under the CJRS, but from the 1st of December that changed. So no, not now. If anybody's leaving or you've given somebody their notice, you need to take them off of furlough and you need to pay them at 100% of their usual earnings, and you can't reclaim that back. For statutory leave that isn't paid in line with the notice or isn't paid because of that they're leaving, you can reclaim furlough for that. So you can reclaim 80%, but the employee still needs to receive 100% of their usual pay for the days that they've taken on holiday.
Thank you. And can we furlough an employee who is on sick leave?
Yes, so furlough shouldn't be used for short periods of sickness. So if somebody's off for 2 days because they've got a stomach bug, you shouldn't put them on furlough just because of that. But if you've got somebody who's on sick and you think they're going to be on sick for some time, or that they were previously on sick and you want to place them on furlough, then you can do, as long as it's for business reasons. So that's absolutely fine.
Thank you. Is redundancy pay tax-free below the 30,000 or any amount is taxed?
So is it tax-free below 30? Yeah, so it's tax-free below 30,000. It's only redundancy payments above 30,000 that are subject to tax. And again, now it's also subject to Class 1A employers and IC.
So that's the statutory redundancy
element?
That's
the statutory redundancy element, yeah. Okay.
And that's everything for questions. Thank you, Phil, for presenting the session this morning. Thanks everybody for joining us. We will, as I mentioned, send the feedback form on email very shortly. Hope you enjoyed the session and we'll see you again soon.
Thank you.
Thank you.
See you.